investors, it's great because we have the ability to still be close to that 1% on the price to rent ratio. So I think that's a lot of things that people are looking at from a single family home side is, hey, if I buy a house for $100,000, I want it to at least rent for $1,000, right? I mean, I remember when we were doing 2% rules, in Kansas City, and so for investors that are looking for that 1% rule, we can still provide that for a lot of different people in different markets. But I think that all of those things together with population and job growth that we've got, as well as the affordability, kind of mixes for a really nice area for investors to feel comfortable maybe moving some money off of the coast and into the Midwest here, where we don't feel when the economy does slow or we have this crazy word that everybody's calling a recession. I think that we don't feel it as much as maybe a coast does, right? Because our rents aren't above $2.50 everywhere. You can still rent a 2-bedroom apartment here in a really safe area for $900 a month. I mean, that's pretty nice. So a lot of people have affordability on their minds, and Kansas City is one of the markets that is always popping up on people's radars.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Logan Freeman, a former NFL player, real estate investor, and founder of Live Free Investments. How are you doing today? And thank you for joining us on the show.
And I'm doing phenomenal today. When people always ask me, I try to say energized, thriving, and focused, and catch them off guard with that. I think I might have got you the first time you called me too.
Absolutely. I love it. I love it.
Yeah.
And one thing that we had talked a couple weeks ago, and one thing that me and you kind of connected is we have a lot of similar in our background. We have a sports background. So we're dealing with a lot of outside investors. We're syndicators as well. But for people who are not familiar with your background, I know you're pretty active online as well as networking meetings locally. Would you mind describing for the audience a little bit about your background story and how you got into real estate?
Absolutely. So, I'm a mid-Missouri boy. I grew up throwing hay on the back of a trailer and washing dishes at a catering company, and I just learned that work ethic real early on. 14 years old, I had to beg the company to take me because, you're really only supposed to have 15-year-olds. But I squeezed in there and started making money so I could start to pinch some pennies together and put them in the bank. So, I got started in real estate investing kind of by happenstance, man. I was living outside of Kansas City. I was studying real estate investment, and everybody probably heard the Little Purple Book, Rich Dad, Poor Dad. Everybody's got it. It's incredible how much outreach that book has had and impact that it's had on people. But it really started as a mindset shift for me. My father passed away, left me a very small amount of money, but to me it was a very large amount of money whenever that happened. And I said, well, I don't think I'm going to go put this into the mutual funds and stocks of the world. And so I started researching, alternative investments and figuring out what I wanted to do with that money. And real estate kept coming up. And so I said, well, let me start reading books. So instead of buying my first property, I bought a lot of these books that you see back here. And I really started networking with people. And I knew I was going to live in Kansas City. So I started getting on forums and talking to individuals and learning about the areas because I didn't really know it that much. And I was working up in Lansing and Michigan and Ann Arbor at the time. So I'd fly in the weekends, check out some houses in some different areas, and then I'd fly back out. Well, I ended up buying my first house from the guy that I ended up going into kind of business with here in Kansas City. And so my first real estate purchase was a flip. I was going to live in it, and I also had my roommate basically pay the mortgage down while I lived, rent-free. Less than 2 years. Here's a great tip for anybody who's doing a flip and doing the live-in flip with your personal residence. Do not move out before 24 months. It was my first lesson in real estate. Is I had to pay about $7,000 of capital gains tax because I literally moved out a week too fast. I mean, a week. So that was my first lesson in real estate. Was the devil is in the details on that front. But after I sold that house, I made about $55,000. lived rent-free for 2 years and put some money into it, I had the bug. So I started researching even more, and I went and took some other jobs at the time. But, I think what was really important for me is to get into the game and start making some purchases and actually taking some action on that stuff. So I went over as a director of acquisitions for a company, a small firm here in Kansas City, and we represented all out-of-state clients. I had no in-state clients, so I had to get really good at understanding how to build rapport and communicate very clearly, concisely, and in a compelling way on the phone. And so this little thing right here, I'm sure you've got yours pretty close to you, that little earpiece right there never comes out of my ear. But I represented a $40 million fund here in Kansas City, and in 2 years we went and purchased around 250 properties for them. Outside of that, I also had about a buyer's list of 150 people that I really helped to curate, all from just adding value off of BiggerPockets, LinkedIn, and my own marketing. And what I learned about that was, again, how to clearly set expectations. I had a really high close rate. If we went under contract with something, might be a commercial building, might be a multifamily property or a single family home. If we went under contract, we knew about all of our risks up front. And I never tried to hide anything from my clients. I put it out there in front and said, look, this is the details. This is what we know. We're going to uncover more in our due diligence phase. But right now, do you feel comfortable? Yes, there's going to be multiple offers, but stick to your number. And I gained a lot of respect, and I think just appreciation from out-of-state clients. And those people talk, man. I mean, it's the 1%ers in the world. They all talk, and they're all networking, and you're only as good as your reputation. So in less than 9 months, we purchased over 120 properties for our investors that buy, renovate, rent it out, and refinance and repeat model. And so I got a lot of exposure to a ton of transactions, which was really, really good for me because I really got to understand how to basically underwrite a property, estimate rehab, negotiate a property, and figure out the due diligence of it before I even went under contract. And I also made a really great name for myself here in Kansas City, being able to do that. I think that was kind of how I got started was I bought that first flip, and I kind of took, 3 or 4 years later, I took the first plunge into, or the head first plunge into actually going full time into it. And now I'm completely focused on commercial and multifamily and my own equity partnerships, syndications, and helping developers kind of work with their capital stacks on the debt and equity side.
Absolutely. Yeah. I love your transition. Cause like I said, it was kind of like how mine started where, I mean, you got your feet wet. I mean, you actually got into a deal.
Yep.
Personally, then you went over to the business side of it, and you had your hand in all the different parts, the moving parts of the deal, from the analyze and look at the deal, the rehab numbers, and the transaction, the PSA, everything down to the end. So that's critical information that you learn that you then transfer over, that you can now bring it to your syndication business and help out your clients. Yep. I also like your process of working with buyers out of state, setting the right expectations. And so it's always to be able to win-win situation. If they really want to buy, you're going to provide them the product that they need and then move it forward instead of just kind of wasting everybody's time. So that's awesome.
Yeah, I think there's two things that you kind of touched on there that I'd like to dive into a little bit. Was I never went and sold anything to any client that I hadn't purchased before. So before I sold or bought before I sold a commercial property, I went and bought 2 of them and went through the whole process myself, because commercial property is a lot different than residential property, which can be a lot different than low income taxes or tax credit properties, which can be a lot different than a Class A multifamily. So I've either, I can't necessarily go purchase a 400 unit Class A multifamily property by myself, but I do have connections that have had that type of experience. So before I ever bring that to my investor group or my clients, I felt really comfortable with the different nuances of that asset class. I think that that's really, really important, is to get in and do it yourself first before you actually come to your clients and ask them to do it.
Absolutely. So you're out in the Kansas City market. So can you kind of tell us about that? I've been, I network with a lot of investors that's been kind of studying that market, have some investments there. You being boots on the ground, can you kind of tell us like a bird's eye view of what that market is and kind of what the attraction is there as well?
Yeah, so Kansas City is an interesting market in the sense that there's a lot of different pockets that you can invest in, and each one kind of provides different specific, I would say, positives and negatives to it. We have the Missouri River that basically cuts off the north, what we'll call North Kansas City, and then South Kansas City. And then the markets around Kansas City, the suburbs, what I'll call Eastern Jackson County, where Lee Summit, Blue Springs, and Oak Park is, and Oak Grove, not Oak Park. There's a lot of different demographics that's going to live there, that is going to live in downtown Kansas City, that's going to live in the Kansas side. That's not even what we've talked about. So Kansas City's right on the border. So there is a Kansas City, Kansas. But I was talking to a gentleman earlier today, and he said, "Oh, you're out in Kansas." I said, "No, we're in Kansas City, Missouri. That's where everything actually is." But southern Johnson County, actually on the Kansas side, is one of the richest counties in the country. So not a lot of people know that there's a lot of wealth south of Kansas City, Missouri, that a lot of people have no idea that's even here. And so there's different markets in Kansas City. I would say there's different sub-markets, obviously. I would say that there's the things that are really driving the growth here is we have really great population growth because it's really affordable to live here. Mm-hmm. You get to have a lot of the different, what I'll call big city feels, sort of big city. It's Missouri, so let's not get too big city here. But you still have the downtown. You have the Power and Light District. You have different entertainment districts, a great shopping district. We have the Country Club Plaza, which is an incredible area for eating and dining out and then shopping. So we have a lot of incredible shopping here because we have such a wealthy, what I call population in the area, which demands really nice, clean, safe areas. There's a lot of job growth here too. Tech is not as big as it is out on the West Coast, but we have we're kind of called the Silicon Prairie out here. So there's not the Silicon Valley, but it's the Silicon Prairie. So we have quite a few startups actually moving here to Kansas City, and we have a great ecosystem. My wife was involved in the Kaufman Foundation, which is a really great ecosystem for startup companies and helping them get their start. And we have quite a bit of venture capital here in the Kansas City area that's interested in backing some of those companies. But I would really say that the thing that outside investors talk about the most is that we've had really great job growth. So if you think about it, Cerner is here, which is a large IT healthcare company, and they're only continuing to grow. H&R Block's headquartered here. Kiowitz, a really large engineering firm here. There's just Burns & McDonnell, again, is a large engineering firm. There's just a lot of different industries, and it's pretty diverse. So we have quite a few people kind of moving here. And then, again, it's just the affordability that we have in Kansas City. So we have a pretty great quality of life here. And if you make anywhere close to six figures, you can really live a really solid life. I would actually say, around $65,000, you can live pretty well anywhere. Investors, it's great because we have the ability to still be close to that 1% on the price to rent ratio. So I think that's a lot of things that people are looking at from a single family home side is, hey, if I buy a house for $100,000, I want it to at least rent for $1,000, right? I mean, I remember when we were doing 2% rules, in Kansas City, and so for investors that are looking for that 1% rule, we can still provide that for a lot of different people in different markets. But I think that all of those things together with population and job growth that we've got, as well as the affordability, kind of mixes for a really nice area for investors to feel comfortable maybe moving some money off of the coast and into the Midwest here, where we don't feel when the economy does slow or we have this crazy word that everybody's calling a recession. I think that we don't feel it as much as maybe a coast does, right? Because our rents aren't above $2.50 everywhere. You can still rent a 2-bedroom apartment here in a really safe area for $900 a month. I mean, that's pretty nice. So a lot of people have affordability on their minds, and Kansas City is one of the markets that is always popping up on people's radars.
Yeah, that is very key. Like I said, if you're looking as an investor, looking into a market, you kind of nail it on the head there. I have a lot of investors on the coast, New York City, New Jersey, Connecticut, that's just moving their money out of there. And they're just looking for anywhere that has any of those intrinsical values. Like I said, the jobs, the diversity of the jobs and everything. And the affordability is key, because when they know when their investment's there, they want to make sure that people's able to, to rent there, they can make some good money. And then when they have any shifts in the market, that everything can be still kind of stable, relatively speaking.
Yeah. Institutional quality assets still are trading, pretty low here. So what I mean by that is built after 1970 in an area that is, a B neighborhood that might be over 100, 150 units. Those are still trading between that 5.5 and 6.5 cap rate, which some people can still make work. Now, out on the coast, I understand that there's two caps and 3 caps that are selling, but that's California, or that might be somewhere up in the Northeast where you're at. But I think that we provide in a specific asset class, that 10 to 50 units. Man, I'm still finding deals that are 9 caps. We just closed on another one last week. That was a 9 cap straight on paper, and there was no denying that it was. And so in a decent growth area. And so those opportunities are still here for investors if they're willing to be patient and do their due diligence up front and come and visit the market. It's really, really important to come check out what's actually happening here, because we're a lot more than just cornfields and beans here in Missouri.
Would you say Missouri is kind of more of a landlord friendly state as far as, like I said, when you're dealing with tenants, or kind of what you've been experienced there?
Most definitely is. I understand that there's quite a few different tenant-friendly laws in maybe Chicago or California or something like that. We're still very landlord-friendly here. An eviction, doesn't take 6 months like it might somewhere else. It doesn't cost you $10,000. With the property management companies that I've been involved with in the past, they have a system and it works, and your tenant might be out between 30 and 45 days, and it might cost you less than $1,000 to get somebody out. So, and rightfully so, right? I mean, and I don't mean by just going and evicting anybody that you want to, but at the same time, if you're on a month-to-month lease and you've been there for 15 years and you have never signed a renewal or anything like that, it's the landlord's obligation or right to maybe raise the rents. And if you don't want to do that, okay, we'll have to go find you somewhere else to live. And so we always obviously try to help people relocate into maybe a more affordable area, but at the same time, we haven't had too many issues with tenants really here in Missouri. It's still pretty landlord friendly.
Yeah. So for the investors, like I said, for California, the Northeast that's looking into the Missouri market, kind of what would be your suggestion? The first approach, would it be talking to a local property manager to see how they can run things, or talk to a consultant investor like yourself to kind of start that process? So what would you suggest with that?
I think it's a great question, and I always try to be cognizant of people's times when I'm on the phone call. So I always say you need to start with the end in mind. So know what type of asset class you're looking in, or you're looking into. Know what type of return that you're going to be looking for. Because if you're asking me to find you a 15 cap in Kansas City, Missouri, I can tell you that I'm not going to rightfully be able to do that for you. And so, I think the asset type, the rate of return, and then your risk tolerance. Are you willing to go somewhere that's on what Victor Menashe would call the path of progress, right? I mean, are you willing to try to buy the line and have the line move, or do you want to buy inside that line and have a safer bet? And so those are the 3 things I always start with: is asset class, rate of return, and your risk tolerance. And that usually allows me to basically dial in kind of where to take the conversation, or to just be upfront and say, you might find that with somebody else here, but I'm not seeing that on a day-to-day basis. And I'm a pretty active investor and broker in my own market. So if you are finding that, you really might want to check the area that you're looking into, because Kansas City still has areas that you don't want to go into, and that the path of progress has not kind of gotten to quite yet. So I would say start with those 3 questions. There's great resources. Bigger Pockets has a lot of local investors where you could go and check out. You can check out the different real estate firms based on the asset class, again, that you're interested in. And then I think talking to an individual like myself might be really helpful, just because I can give you some color into the different areas of the city to kind of stay away from or go into, as well as, just setting expectations up front that, most of the good deals that are still happening here aren't really being marketed full on fledged. So it's my job to kind of sit down with an out-of-state client and work them through what I have like a 4 or 5, kind of point, what I'll call progress report, let's just say, that I help them go through to kind of say, look, we need to do these things up front before any seller is actually going to take you seriously. Because a sophisticated enough seller that's selling their own property themselves they're going to vet out that buyer just as much as they're going to vet out the purchase price and the terms. They want to know, have you closed properties before? What type of properties were they? When was the last time you did it? And they want to see proof of funds. And so I work my clients through this process of trying to put their best foot forward into the, to the seller, so they can say that, they could feel comfortable if you do want to go under contract. One, you're going to perform, and two, you're going to be able to close. Absolutely.
Yeah. Especially you coming from an outside, no one really knows you. The seller is trying to, figure out what type of person this is. So that's, like I said, that's great tips there. As far as investors that you've been noticing coming into the market recently, are they looking for more kind of turnkey? Or are they kind of looking at, we had mentioned several different types of assets like office, retail, single tenant, multifamily. So are they kind of looking for kind of, a done for them type of thing, or what kind of stuff you've been seeing?
I think everybody has been, what I'll say, classically conditioned to look for value add, right? And, being a first time investor, I would definitely caution them to go into a large value add project, because most of the assets that are available for purchase here in Kansas City are older, what I'll say 1920s circa properties that are anywhere from 10 to 50 units. And, with those types of buildings, you need to have some experience in being able to renovate those buildings. But most of the time, it depends on the type of money that what I'll say the type of money is coming into Kansas City. If it's a 1031 exchange, that's maybe a little bit less risky because they made a lot of money on an appreciation play, and now they really were focused on wealth preservation instead of wealth growth and the appreciation piece of it. I would say that they're looking for more of a triple net lease type of situation, or a stabilized value, stabilized multifamily asset, which is sometimes hard to come by here. So a lot of if you're looking at a property that you would like to try to get some type of 9 to 9.5, capitalization rate on, there is going to need to be probably some type of value add component to that. In relation to turnkey properties, I think that a lot of investors have different definitions of turnkey, right? So, I always try to work through, what do you actually mean by turnkey? Do you need management? Do you need leasing? Do you need some construction? What do you need to feel like you have a turnkey property? Because if I can provide you all of those services, because I'm opening up my book of recommendations and my network here, you might actually think about doing something that you need to put up a little bit more effort and time up front, but you can maybe refinance your money back out in 3 years. And a lot of people don't even know that, to be quite honest with you. They just they don't know the education around what a commercial loan looks like. They don't know that you can do a construction loan on a commercial loan, and they might not know how much it takes to put down, how the draw process works, and how maybe even the appraisal process works, right? I mean, I don't know about your market right now, but most of the projects we're getting completed and financed have 3 appraised values. They have a as is, they have a stabilized, and an as complete value. And right now we're really selling pro formas and as completed, because most of the large value add projects we've been working on, I've been able to reach out to a seller who might have owned it for 25, 30 years, and they've never raised the rents since 1990. And there's still somebody paying $550 for a apartment that can rent for $1,000 if they just put some paint, some new flooring, and some stainless steel apartment or appliances in there. So I think just the educational process of what that looks like is really important. And I've had a lot of success actually educating on different types of asset classes. So maybe somebody comes to me and says, hey, Logan, I'd really love to find a value add multifamily apartment deal in Kansas City. Here's my rate of return that I'm looking for, minimum 10% cash on cash return after stabilization for those first 4 quarters. I said, okay, well, let me show you what we can get for that, and this is what you're looking towards. And they might really be disappointed in the number of doors that they can get, or the area that they're going to have to be in. And so I've been able to take those types of individuals, wrap their head around maybe doing a commercial mixed-use development type of project, where you take a really great building in a great area, lease it up for them during the due diligence phase, which is awesome. So you negotiate the ability to market the property during the due diligence phase. If it's ready to be marketed and you can lease it up, I've placed tenants in buildings on the day of close for my clients. And then maybe you look at it and has some ability to have residential upstairs on the second floor, and maybe it's in such a great area that you should turn one of them into a short-term rental. You know, I have a great example of that. We placed a tattoo shop in the bottom half of a 7,500 square foot building. I had 3 other commercial tenants on the main level too, and then upstairs it had 2 long-term apartments. Well, being an Airbnb owner myself, I recognized the area, called my manager and got some comps on what that area would do. And I said, man, you could double your income on this property. And he's actually getting ready to go live, and they're actually projecting that it's going to be about a 75% increase from a short-term rental from a long-term rental to a short-term rental. So it's just things like that are really important. And that investor client first asked me to find a multifamily property, and we ended up on a commercial mixed-use building that he's going to be able to refinance all of his money out in 24 months and go do it again and have an awesome asset in a great location.
Yeah, I like that you take it right from that macro perspective, bring it down, kind of find out specifically what they're looking for, what they need, and find an ultimate solution for stuff that they may not even been thinking about.
Exactly.
Now you not only able to return all of his capital, but now he's giving him the ability to go out and do it again. Now you create a lifelong client and happy investor on top of that.
Exactly, and it feeds my business too, right? I mean, if he's going to be a repeat customer and going to tell all of his buddies up in Massachusetts that, hey, man, you need to talk to this guy because he's finding some great properties out in the Midwest that are yielding really great, that helps me out as well. And I think that's really important. That's what we're here for. You understand that, and you're only as good as your reputation in this business.
Absolutely. So if you could talk about a little about your syndication business. I know you've been growing that and kind of developing that. Is there a specific targeted investments, properties that you're looking for? Like what's kind of you guys are doing? Yeah,
so I fell into raising equity for our syndications in an asset class where probably a lot of your listeners are not going to think that there was some yield at. But again, I was able to see the diamond in the rough and say that property is in a great area. I have some background in this. I think if I find the right operational partners, this can be a home run. And it's actually in bed and breakfast hotels. So we acquired 2 bed and breakfast hotels, and we're working on our 3rd one right now out in Wichita, Kansas. So basically, I was kind of surfing the web one day, and I came across this property, and I was like, man, I know exactly where that's at. That's a really good property. I kind of jumped on the website, saw that it was an operating bed and breakfast. I called the broker up, and I said, look, he's a residential guy. And so I said, look, I would love to understand the numbers a little bit better on this. Signed the NDA. I got on the phone with a consultant for a bed and breakfast operating company, and she walked me through all these different numbers. And I have some hotel background with my undergrad being hotel and restaurant management, and I was able to make some calls to some people and say, is this in line to what you were thinking? And after I evaluated the numbers and the financials for the last 36 months, I looked at the area. I looked at almost just single family home comps just in that area that were similar type, and the purchase price alone was basically enough just to cover the real estate, not the business in that, because they're having a really hard time finding a buyer for a bed and breakfast hotel, which I can understand. But the real estate itself, if somebody was just to kind of move into that property, would have been worth what we were able to get it under contract for, which is great. But the business on top of that added, oh my gosh, probably 50-65% of net operating income that you would not see on a regular property. So we syndicated both of those just from a regular 506 B and C syndication. So we did we hired a securities attorney, and I was able to transfer a lot of people that I had made connections with on the single family and small multifamily and multifamily side into saying, look guys, I've got a number of spots here. It's a little bit of a niche product, but here are the numbers, and the numbers didn't lie. And so the last piece I had to figure out were the operations. And so our brokerage firm was actually focused on moving into the hospitality space. We just hired a COO that came over from Marriott. He had a long stint in Marriott, felt really good about operating hotels. So it's just kind of this whirlwind of perfect kind of timing and me bringing the investors and the different components to it and bringing it to somebody's attention that I felt, because I didn't have at the time, I didn't have the balance sheet to be able to go support a purchase price of that by myself. So I had to have partners that had, 1, more experience, and 2, had a better balance sheet that could help support some of that. So that's I'm not saying that we're going to go focus on just doing bed and breakfast hotels. My partners own over 700 apartments, a bunch of commercial buildings. I have a couple commercial buildings as well. I would say that our focus now is trying to find that one or two multifamily deals still left in Kansas City by utilizing our network. So true off-market opportunities. And then what we've done in the past is just reposition those assets. Never have had to have outside money for these opportunities, but we're on a scale now where we're actually bringing on some money partners now, and we'll probably reposition one 115-unit apartment complex here in Kansas City, as well as we're supporting new developers in the city. So I'm not a new construction guy. I've never done necessarily new construction, but we have partners that we help on the property management side, and we have been asked by them to maybe help on the capital side of things. So the debt and equity, making those connections to the right people to help their development go. So they might have we're working on an 85-unit new development right now, and they need a certain amount of equity, and it's a certain amount of equity that they're bringing to the table, and we're able to maybe utilize some of the connections that I've made with private equity firms or family offices, and we're able to bring those people in and say, look, this is what we're doing. We're going to be focused on the leasing, the property management, and we're putting our own money into this deal. Would you be interested? And we've had some success with doing that on the senior living side, multifamily, new development, as well as self-storage, and focused on some opportunities zone projects as well.
Yeah, you got a pretty broad, diverse touch as far as, different asset classes and debt and equity and stuff like that. So yeah, that's awesome. Yeah, you kind of answered a lot of my questions within your answer there. As far as like the whole process, like I said, the bed and breakfast, your other stuff, was there any kind of things that you learned along the way that you said maybe we could have did a little bit differently that you now do correctly that helps kind of, further and better that process?
I would say if you are going to go raise money from accredited investors or non-accredited investors, one, do your research on the type of syndication that you need to set up. But I would say managing that process better would be an incredible a touch point for somebody who's starting off. So those first two that we did, they were just incredibly painful from a document standpoint, being able to manage all of the different investors' expectations, working through operating agreements with 15 different lawyers. I mean, it was really a bear when we had to do that. So I would say that following a process from start to finish on maybe having all the documents on an investor management platforms, there's a lot of them out there. And if you're going to be a syndicator for a long term, I think you should probably go invest in one of those. Sterling White has a really cheap version of one that's a really great option for people. It's Syndication Pro, I think, is what it is. And he's a bigger pockets guy, so people can check him out. I've talked to him a few times. But having the ability for them to go on, look at all the documents, all the subscription documents, all the operating documents, and even fund through that. I mean, we probably had 50, 65 hours just in doing the administrative work of that. Now, we had an executive admin helping us through that, but she has no idea about, making changes to an operating agreement. She just knows how to facilitate all the different things. So I would say make sure to not underestimate the time that it's actually going to take to do the actual work that will keep your investors really happy. Because at the end of the day, that's what you are. You are a fiduciary for your investors' capital and those relationships. And so being able to make sure that you service them in the best way possible is really, really important. So we made up for it by just making ourselves available, being very transparent and honest, and making it right whenever we messed up on that front. Not that the deal was bad, but we had never had to go through this whole process with a securities attorney that, if Dwaine, you know this, it's a lot of work to work through. So we grossly underestimated the time that was actually going to take to do that.
Yeah, absolutely. That's some great tips there, because I've talked to a lot of syndicators, and that's one of the kind of the reoccurring challenges that comes up is this: people underestimate it because sometimes that little work can expand on you, and you just kind of get things, and you really want to focus on getting the deal done. And then if it's under escrow, you have certain timelines and time limits that you have to get to perform. So making sure you have a system like you had referred to us, and we'll make sure to put that in the show notes, to kind of help facilitate the process as best as you can. And then, having everybody on board, available, transparent to talk to investors, walk them through, let them know that we're here with you and we're going to get this thing done properly.
Yeah, I would say that I would make it a line item in the deal. I really would. I would say from day one that, you're going to put this as a line item in the project, that, you're going to get reimbursed at some point throughout the deal for it, but either hire it out or make sure you have hours to allocate towards that, because that wasn't the only thing we were doing, right? It's, we also had 15 other transactions going, and it's not that we could just stop and focus, but we had to, right? And so that was really painful, because we had to stop and make sure that we fixed all of this before we went forward. So my only piece of advice on that is what my old football coaches used to tell me, and said, be quick, but don't hurry. Slow down to go fast. I think that if you get overexcited and you move past, from step 1 to step 4 without doing 2 and 3, you're really going to hurt yourself in the long run. So, be quick, but don't hurry on that process, and make it a line item in the deal that either you're putting up money up front to have somebody manage that for you because you believe in it or not, or make yourself available for a certain amount of hours. And, if your listeners want to talk to me more about that, on how much time it actually takes and the different resources on that, I'm happy to do that as well.
Yeah, good stuff. I love it. So let's talk about kind of transitioning to your investors, networking. I understand you're the host of the local Phoebe group. Yeah. Can you tell me how that's doing? When do you guys meet, and kind of what you talk about in those groups?
Sure. I flew down to the Real Estate Guys event, The Secrets of Successful Syndication, a few years back down in Dallas, Texas. Highly recommend going to that event. Russ Gray and Robert Helm's been doing this longer than I've been alive, and those guys know exactly what they're doing. I learned so much at that event. One thing that I took away from that was that they always said to build your brand and build your network. Those are two things that you can do from day one. Build your brand and build your network. And if you don't do anything else, if you can focus on those two things, you're going to continue to raise your level of experience up. So through that, I read Joe Fairless's book, which is right over here somewhere, Apartment Syndication book. And, I listened to a lot of his podcasts, and I really respect the guy. And he puts it all out there in a book. Well, he has a resource that's 24 ways to find off-market properties, right? And 1, I want to buy property myself, and 2, I want to help my clients buy property. So I literally went down the list of the items that Joe really recommended, and I'm happy to share that with you, Dwaine. It's just a great resource. I started doing them, right? So one of them was get on podcasts and tell people what you're doing. The second one was go to other people's meetups and tell people what you're doing and add value. The third one was start your own meetup. And so I was approached by a gentleman that's I really respect here in Kansas City, and he said, look, you have a great network already. I'd love to maybe think about starting a meetup group here. And I said, yeah, well, another real estate meetup. It's like, how many of those are that you really want to do? He said, no, this is a nonprofit. It has a charter of rules and organization that you have to follow. You can't sell. You can't do anything of this. It's just education. I said, oh, well, maybe I can plug into that. And so For Investors by Investors, Phoebe, like you mentioned, has about 39,000 members out on the West Coast already. There's about 9 chapters out there, and they're very, very prevalent out in the California area. And we decided to start that first chapter kind of outside of California here in Kansas City. So again, there's no selling. It's just educational content. We bring in the best of the best panelists to come in, and we ask them questions for about 25 minutes. I moderate the thing, and then we probably have 65, 70 people show up, and then they ask the panel questions, and then it's just networking. I found a few buyer clients through that network. I know my title company has grown exponentially from sponsoring the deal and having a lot of clients come to them asking about maybe wholesaling or double closes or something of that nature that they might want clarification about. My lenders are there helping people understand the difference between institutional debt, agency debt, and what a commercial loan is. We had CBRE there the other day. Their researchers talking about the different landscapes in downtown network and how it's changing, and how all the development that's happening, and it's not stopping anywhere soon. I would never have known that if I had not reached out to them and said, hey, do you have a researcher here? Well, everybody's like, well, what's the runway of Class A multifamily being built? And from their studies and from their numbers, man, 1 light and 2 light are already 300 plus units down there. 3 light and 4 light are already in works. So this runway in Kansas City is strong. And I would not have known that if I didn't have that meetup sitting there talking to a researcher who that's all she does all day long. And she's got connections with all the major developers, and she knows what's going on. So it's just things like that that's really, really important. And, man, relationships is where it's at in real estate. You know, as I've been working with other developers and sponsors on looking at their projects to maybe bring some debt or equity to the table for them, or making some introductions for them that might be really, really fruitful, the one thing that I have noticed that what my family offices and private equity groups do is they won't even get to the deal until they really feel good about the people. At the end of the day, a pro forma is just a bunch of numbers on a piece of sheet of paper. And if you can't feel really good about the person behind that pro forma and who's actually going to be doing the work, there's no reason for us to be talking, right? So it's my job to vet that person and then bring the numbers to the smarter people who've been underwriting, you know, deals for 25 years and can look at it really quickly and say, no, that's not going to work. That's not going to work. And things that I would never have known, no matter how many books I read, right? It's just a rep game. And so the relationships piece of it is really, really important. And that's what I'm focused on is building my brand and building my network and trying to add value to other people. My number one quote in life is from old Zig Ziglar. And he talks about, if you help enough other people get what they want in life, ultimately you're going to get what you want. If you can just delay your gratification for long enough to help somebody else do something that they're trying to do, it's going to come back and it's going to really, really be fruitful for you in the end. So I'm all about building new relationships and also providing value to my existing relationship base. I think that's one thing that a lot of people in real estate maybe forget about is like if you're going to be successful in real estate, you probably already have a really good network in your local market. You need to ask yourself, what are you doing to service that clientele and those service providers that help you close the property, get you insurance, do all these things. So we throw events for our service providers because we could not do what we want to do as syndicators, as brokers, as limited partners, as any of those things, if we don't have those service providers, title companies, lenders, all those types of individuals, general contractors. You know, if you want to be successful in real estate, have a good general contractor and make sure that he feels really good about what you're doing. So it's really important to value your current network, but also continue to build it.
Yeah, I love your whole process. The whole networking thing is spot on. Just about giving value. I love how you kind of structure it. Information only, just providing good quality networks for people, stuff that people can really get some useful tips from. Because I used to go to all real estate meetings and it's just selling, and to the point you just kind of you get kind of turned off. But if you set up a platform where you bring in local people that know the marketplace, attorneys, CPAs, all the people that people need to get done, and you get more out of that moving forward. So hats off to you. That's a really good job there.
Yeah, thank you. It's been a wonderful experience so far.
Awesome. So like when you're not working, what's kind of like a typical day for you?
So Sundays, that's really about it. Church on Sundays, most definitely spend time with my 4-month-old baby girl, Isabella, and my wife. My wife is the wind between my wings or beneath my wings. And I wouldn't be able to do anything that I do on a regular basis without those two girls that are really filling me up and making me really motivated every single morning. So it's spending time with them, taking my wife out on dates. I love to go out to eat. So as you can see, I'm not a small guy. So I love to eat food and I love good cocktails and just good conversation with people. So like we were talking a little bit, I'm an ex-athlete a little bit. So I like to hoop it up a little bit every once in a while. And of course me, I just can't go play basketball. It's a networking event as well. So I've already found some great deals, through the networking event that I'm playing basketball at on Friday mornings. So
love it.
And I love to read, man. So if I can find time, I try to educate myself and read and just find some quiet space is really important to be able to think, journal, and focus on what's actually going around in your life. So I've done a journal for the last 6 years every single morning. I use a structured journal. For me, it works better I did Darren Hardy's Living Your Best Year Ever journal, which was a game changer for me. But now I just recently transferred over to Brendan Burchard's high performance productivity planner. And while it is a lot of work, but it is so important to understand what was working. I can look back 5 months from now. I can pull out my journal and I can see what was working for myself, what wasn't working for myself, where I was mentally, physically, emotionally. All of that's documented. So I have no excuses for myself if I don't continue to level up, because it's all documented. I got 15 journals right back here, and they all look the same. So I can just find the dates and look and see what was going on in that. And so I do that selfishly too, because I think my kids are going to be really interested to know what their dad was doing, when he was 24, and then maybe now that he's, 30 years old, what is he doing now, and look at that change. So trying to find some headspace to just be quiet and be able to journal every single day is really, really important. So
is there also anything else that's on top of your morning routine? Is there any specific things that you do besides from that?
I'm a Jocko Willink guy. He wrote Extreme Ownership, and his whole mantra is discipline equals freedom. And so I read that book. He actually has a field manual. So and it has kind of a diet and exercise, but also a lot of mentality stuff to it as well. And people can make fun of you for listening to motivational things and things like that. But training your subconscious, it works, and it's important. And when it does work is when the going gets tough. I haven't been in a situation where I've stuttered over my words in a long time, because I'm confident enough with my mentality that I've been focused on, my psychology, that I can handle anything that's thrown at me. I don't have to react. I don't react. I've studied emotional intelligence. I don't have to. So I wake up between 4 and 5 a.m., depending on the night before, what type of hours I got for sleep. But I wake up, that's 4 a.m. to 4:30 a.m. every single morning. I hit the gym. So I get the gym in, and then I get my prayer and quiet time in before I do anything else after I get ready. I might feed the baby girl in there if she's up and going, so I might get her feeding and let her mom go relax for a little bit. And then it's an hour on the journal. It really is. And so that journal takes me a long time to do every single morning and at night. It's about a 20-minute deal at night to kind of review the day. So really, at the gym, there's a lot of affirmations going on in there. Jocko Willink has a fantastic affirmation. I listen to a lot of David Goggins as well. Can't Hurt Me. There he is. Right here. This book was incredible, game changer. And then Grant Cardone's in my ear every day, either through a podcast or the 10X Rule or Sell or Be Sold. Those are the three things that I listen to with Grant Cardone, just from bashing through any limiting beliefs that you think you have. I mean, if anybody can do it, that guy's living proof, right? I mean, he owns 6,000 units, and at one point he was a druggie. If anybody can do it, it's that guy, and he's really just applied those success principles. So my morning routine looks like exercise. I follow Hal Elrod's Miracle Morning. It's just my own version, and his is Savers. It's silence, affirmations, visualization, exercise, reading, and scribing. So it's my own kind of play on that, right? And it's changed. And one thing that I always have tried to be is you got to be hard on disciplines but soft on schedules. So your life is going to change, and don't hold yourself hostage when it does change and you don't get your workout in. Do it later tonight, but you need to be hard on those disciplines but soft on schedules, because sometimes you can't control everything. And so it's really important to know that. And as I've continued to progress on the professional and personal development, I've had to let myself kind of be okay with not being as regimented in the mornings but I do focus on exercise, prayer, and my journal, no matter what. Those are the three things that I do.
Beautiful. Man, you load us up with so much value, and really, really appreciate that. So we covered your business, syndications, your process of networking and kind of being successful, your routine and everything. That's great. So how do we get in touch with you? I know people probably get really excited once this episode releases. Yeah. How do we get in touch with you and your company?
Yeah, so I can be found at livefreeinvestments.com. And that's just LIVEFREE investments.com. So my last name is Freeman. And my whole mantra or my whole brand has always been live free, because we get into this in a different episode or something like that, but I was fired from my job over 24 months ago now. And the day that I was fired, people were like, man, that sucks, and I said, no, actually it freed my mind to live free. And so that was my new kind of thing, was I want to always live free. And so I think that real estate can help you to get to that point. It's the great vehicle to do that. And so livefreeinvestments.com, there's a contact me on that page. You can get me at Bigger Pockets as well, Logan Freeman. I'm all over the Kansas City Bigger Pockets page, trying to add value to people that way. On social media, Live Free Investments, Instagram, LinkedIn, Logan Freeman. You guys can find me. I'm
Beautiful.
very accessible.
Awesome. Yeah. Thank you so much again. We look to connect with you again in the future. Good luck with all your future endeavors, and bless to you and your family. And thanks again for joining us on the show.
Thank you for having me, Dwaine. It was awesome.
Take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.